Now, since we have discussed the introduction and what are financial ratios, let's discuss on with the categories of financial ratios. The first one is financial performance profitability ratios. Now, further, they are subcategorized into different ratios. The first one is return on capital employed, also known as ROCE. The aim of profitability ratios is to assess the financial performance of a profit-making entity and the return that it makes on the capital invested. Profit-making companies should try to make a profit that is large enough in relation to the amount of money or capital invested in the business. The most important profitability ratio is probably return on capital employed. Its formula is ROCE is equals to profit before interest and taxes over share capital and reserves plus long-term debt capital plus preference share capital, and since it is expressed in a percentage you are multiplying it with 100. Capital employed is the share capital and reserves plus long-term debt capital such as bank loans, bonds and loan stock. This ratio actually shows how much return a company is earning out of the total capital invested. Now the total capital includes capital invested by the company on its own, that's the shareholders' capital, the capital invested by the lenders of the company, and thirdly, the preference shareholders who have invested in the company. Where possible, use the average capital employed during the year. This is usually the average of the capital employed at the beginning of the year and at the end of the year. This ratio is most needed by lenders in the form of, say, loans, debentures, loan stock, etc., and preference shareholders. Now let's discuss the second ratio, return on shareholders' capital, also known as ROSC. Return on shareholder capital measures the return on investment that shareholders of the company have made. Now these are the ordinary shareholders. Its formula is profit after taxation and preference dividends over share capital and reserves. This is also expressed in percentage, so you are multiplying it with 100. The average value of shareholder capital should be used if possible. This is the average of shareholder capital at the beginning and at the end of the year. Profit after tax is used as the most suitable measure of the return for the shareholders, since this is a measure of earnings, that is, these are the funds available for payment as dividends or for reinvestment in the business. Let's move on towards the third ratio, return on assets, or ROA. Return on assets measures the return on total assets employed within the company, that is both non-current and current assets. Its formula is profit before interest and taxes over assets. It's the same, it's expressed in percentage, so it's multiplied by 100. Now let's move forward. The size of the return on capital employed or the size of the return on shareholders' capital depend on two factors. Firstly, the profitability of the goods or services that the entity has sold, and the volume of sales that the entity has achieved with the capital and assets it has employed. This is also known as asset utilization or asset turnover. Okay, let's move on towards the next ratio, profit sales ratio or cost sales ratio. The profit sales ratio is the ratio of the profit that has been achieved for every rupee 1 of sales. Now, Its formula is profit upon sales into 100%. Profit sales ratio are commonly used by management to assess financial performance. The definition of profit can be any of the following: profit before interest and tax, gross profit, that is sales minus cost of sales, net profit, profit after tax. It is also useful to compare the net profit ratio with the gross profit ratio. A high gross profit ratio and a low net profit ratio indicate high overhead cost for the administrative expenses and selling and distribution expenses. Asset turnover ratio. The asset turnover ratio is the ratio of sales to capital employed. It measures the amount of sales achieved during the period for every rupee one of investment in assets. Assets turnover ratio is equal to sales upon share capital plus reserves plus long-term debt into 100%. Now this ends our discussion on profitability and financial performance ratios. Now if you need further clarification on any of the ratios, you can actually subscribe to our channel and you can comment. Thank you. Now in the next session we will start off with other categories of the financial ratios. Thanks.